I'm going to show you 5 charts, not opinions, not narratives, not hopium, just data. 5 technical indicators that are all saying the same thing at the same time. And when multiple independent indicators converge like this, it's not a coincidence. It's a signal. I've pulled the charts. I've run the numbers. And what I'm seeing is a setup that I haven't seen in silver since before the last major move. So I'm going to walk you through each chart, explain what the indicator is measuring, show you what it's telling us right now, and then connect all 5 into a coherent picture of what's setting up. And by the end of this, you'll have a framework to verify this yourself, because I'm going to tell you exactly where to find these charts and how to read them, right now as I'm putting this together. Comment when you're watching, because these indicators update daily, and if you're seeing this in real time, you can track whether the setup I'm about to show you continues to tighten or if it resolves. And if you value data over drama, if you want technical analysis that shows you the actual charts instead of just talking about them, subscribe and comment FinTalk OG so the algorithm knows you're here for the evidence. Now, before I show you the charts, let me frame what we're looking for. When you're trying to anticipate a big move in any asset, you want confirmation from multiple angles. You want momentum indicators telling you something. You want volatility indicators telling you something. You want positioning data telling you something. And you want volume confirming it. When one indicator flashes a signal, it's interesting. When 2 flash together, it's notable. When 5 independent indicators all converge at the same time, that's when you pay attention. Because the probability that all 5 are wrong simultaneously is much lower than the probability that one is wrong. That's what we're looking at right now in silver. Here are the 5 charts I'm going to show you. Chart 1, the MACD, which measures momentum and trend direction. Chart 2, the RC, which measures whether an asset is overbought or oversold. Chart 3, Bollinger Bands, which measure volatility and compression. Chart 4, volume trends, which tell you whether moves are real or fake. And Chart 5, the Commitment of Traders report, which shows you how commercial hedgers versus speculators are positioned. Let's go through them one by one. Chart 1, MACD. The Moving Average Convergence-Divergence Indicator. This is a momentum indicator that shows the relationship between 2 moving averages of price. When the MACD line crosses above the signal line, that's a bullish crossover. It suggests momentum is shifting positive. When it crosses below, that's bearish. Right now, on the daily silver chart, the MACD is setting up for a bullish crossover. It hasn't crossed yet as I'm recording this, but it's close. The 2 lines are converging, and the histogram, which shows the distance between them, is shrinking towards 0. This is classic pre-breakout behavior. But here's what makes it more significant. The MACD is also showing a bullish divergence on the weekly chart. What's a divergence? That's when price makes a lower low, but the MACD makes a higher low. It means that even though price dropped, the momentum behind that drop was weaker. It's a sign that selling pressure is exhausted and a reversal might be coming. Silver price bottomed in the low 70s after the crash from 121. If you look at the MACD at that bottom compared to previous lows, the MACD is higher. That's bullish divergence. And divergences on weekly charts are more reliable than on daily charts because they filter out noise. So the MACD is telling us 2 things. Momentum is about to turn positive on the daily time frame, and on the weekly time frame the recent sell-off was weak and momentum is building for a reversal. That's signal 1. Chart 2, RSI. The Relative Strength Index. This measures whether an asset is overbought or oversold on a scale of 0 to 100. Above 70 is overbought. Below 30 is oversold. Right now, silver's RSI on the daily chart is sitting in the 45 to 55 range. That's neutral. It's not overbought, which means there's room to run higher without hitting resistance from technical signals. And it's not oversold, which means we're not in panic selling territory. Neutral RSI is actually ideal for a breakout setup because it means the asset isn't stretched in either direction. But here's the more interesting part. On the weekly RSI, silver is coming out of oversold territory. During the crash to the 70s, weekly RSI dropped into the low 30s. That's deeply oversold. Since then, it's been recovering and is now back above 40. When RSI recovers from oversold levels, it often precedes a sustained move higher. The asset has reset. Weak hands have been shaken out, and now there's room for a new leg up without immediately hitting overbought conditions. What I'm watching for is the daily RSI to break above 55 with conviction. If it does and holds, that's confirmation that momentum is building. And if the weekly RSI continues climbing toward 50 and 60, that tells me the broader trend is turning bullish. RSI is telling us that silver is not overstretched. It's in a neutral to recovering zone. That's the ideal launch pad for a big move. That's signal 2. Chart 3, Bollinger Bands. This is a volatility indicator. Bollinger Bands are plotted 2 standard deviations above and below a moving average. When the bands are wide, volatility is high. When the bands are narrow, volatility is low. And here's the key insight. When volatility gets extremely low, meaning the bands squeeze tight together, it almost always precedes a big move. The market is coiling, and when it uncoils, price explodes in one direction or the other. Right now, silver's Bollinger Bands on the daily chart are in a squeeze. The bands are narrower than they've been in months. That means price is consolidating in a tight range, and volatility has collapsed. Historically, when silver's Bollinger Bands squeeze like this, the subsequent move is significant. It doesn't tell you the direction, but it tells you magnitude. A breakout from a Bollinger squeeze tends to be violent. If silver breaks above the upper band, it could run fast. If it breaks below the lower band, it could drop hard, but it's not going to stay inside the squeeze for long. What makes this more compelling is that the weekly Bollinger Bands are also starting to tighten. That's rarer. A squeeze on both daily and weekly time frames means volatility is being compressed on multiple levels. And when that releases, the moves are often measured in double-digit percentage swings in a matter of days or weeks. The Bollinger Bands are telling us that a big move is imminent. The market is coiled, and it's about to snap. That's signal 3. Chart 4, Volume. Volume is one of the most underrated indicators. It tells you whether a price move is real or fake. If price moves on high volume, that's conviction. Buyers or sellers are committed. If price moves on low volume, that's weak. It's likely to reverse because there's no follow-through. Right now, volume in silver has been declining during the recent consolidation. That's normal. When price chops sideways, volume dries up because there's no clear trend and traders step to the sidelines. But here's what I'm watching for. A breakout on high volume. If silver breaks above resistance, let's say 88, and volume spikes significantly above the recent average, that's confirmation. It tells you the breakout is real. Institutional money is participating, and the move has legs. Conversely, if silver breaks out on weak volume, that's a red flag. It's likely a false breakout that will fail. Volume is the truth serum of price action. What's interesting right now is that during the recent dips toward the mid-70s, volume also declined. That tells me sellers aren't aggressive. There's no panic. There's no capitulation. It's just low conviction chopping. And when you see low volume on both rallies and sell-offs, it means the market is waiting. It's compressed. And when the catalyst hits and volume surges, that's when the real move begins. Volume is telling us the market is in standby mode, and the next high volume move will set the direction. That's signal 4. Chart 5, Commitment of Traders Report. This is positioning data published weekly by the CFTC. It shows how different types of traders are positioned in the futures market. The two key groups are commercial hedgers and non-commercial speculators. Commercial hedgers are producers, refiners, industrial users. They hedge their business risk. When they're net short, it usually means they're hedging production or inventory. When they're net long, it's less common, but can indicate they're hedging future purchase needs. Non-commercial speculators are hedge funds, trading firms, large speculators. They trade for profit, not to hedge business risk. Here's the pattern that matters. When non-commercials are extremely long and commercials are extremely short, that's often a top. The speculators are all in, and the commercials are on the other side waiting to sell to them. When non-commercials are extremely short or neutral, and commercials are reducing their shorts or even going long, that's often a bottom. The smart money, the commercials, are positioned for higher prices. Right now, the latest COT data shows that non-commercial net long positions in silver are not extreme. They're moderate. After the crash from 121, a lot of speculative longs got flushed out. And commercial short positions have also declined. That means the commercials are less bearish than they were at the top. This is a healthier setup. When speculative positioning is not extreme, there's room for new buying without immediately hitting a crowded trade. And when commercial shorts are declining, it suggests that the entities who actually deal in physical silver are less worried about downside. They're not aggressively hedging against a collapse. The COT data is telling us that positioning has reset. Speculators aren't over-leveraged long. Commercials aren't massively short. That's a neutral to bullish setup, and it removes one of the major headwinds that can cap rallies. That's signal 5. Now let's put it all together. MACD is showing momentum turning positive and bullish divergence on the weekly chart. RSI is in a neutral to recovering zone, not overbought, with room to run. Bollinger Bands are squeezed tight on both daily and weekly time frames, signaling an imminent volatility expansion. Volume is low, indicating the market is in standby mode waiting for a catalyst. And COT positioning is reset, with speculators not extreme and commercials less bearish. 5 independent indicators, all saying the same thing. Silver is coiled, it's compressed, and it's setting up for a big move. Now here's the critical question. Which direction? The indicators tell you a move is coming. They don't guarantee direction. But when you combine the technical setup with the fundamental backdrop, refining bottlenecks, industrial demand, institutional accumulation, the probability tilts bullish. A breakout above 88 on high volume with MACD crossing bullish and RSI climbing would be a very strong buy signal. A breakdown below 72 would invalidate the setup and suggest the consolidation needs more time. What I'm watching for specifically is a trigger, a catalyst. It could be Fed data. It could be a COMEX delivery squeeze. It could be a geopolitical event. It could be a major institution announcing a large physical purchase. Whatever the trigger is, when it hits and volume surges, these 5 indicators tell me the move will be significant. And the direction will likely be up based on the fundamental tightness I've covered in previous videos. Here's how I'm positioning around this setup. I'm already holding a core position in physical silver. That doesn't change. But I'm prepared to add on a confirmed breakout above 88 if volume confirms it. I'm not chasing. I'm not front-running. I'm waiting for the break and the confirmation. And if we get it, I'll add a position sized appropriately with a stop loss below 84. If the breakout fails and we reverse back into the range, I'll cut that add and reassess. On the flip side, if silver breaks below 72, I'm not adding. I'm holding my core but not increasing exposure until the setup rebuilds. For traders, this setup is a coiled spring. You can trade the breakout or breakdown with tight stops, but you have to be disciplined. If you buy the break above 88 and it fails, you cut at 84. If you short the break below 72 and it fails, you cover at 76. No hoping, no praying. The setup either works or it doesn't. For long-term holders, this is just information. You hold through the noise. But it's useful to know that the technical setup is aligning with the fundamental thesis. It increases confidence. Let me also show you where you can verify these charts yourself. MACD, RSI, and Bollinger Bands are available on any charting platform. TradingView, Thinkorswim, even free platforms like Yahoo Finance or investing.com. Just pull up a silver chart, select the daily or weekly time frame, and add the indicators. MACD is usually under momentum indicators. RSI is under oscillators. Bollinger Bands are under volatility. Volume is automatically displayed at the bottom of most charts. And the COT report is published every Friday by the CFTC. You can find it on their website or aggregate it on sites like BarChart or commitmentoftraders.org. I'm not asking you to trust me. I'm asking you to verify the data yourself. Here's what could invalidate this setup. If the MACD fails to cross bullish and instead rolls over and crosses bearish, that's a red flag. It means momentum is dying and we could see more downside. If RSI on the weekly chart fails to hold above 40 and drops back into the 30s, that's another sign of weakness. If the Bollinger Bands break to the downside instead of the upside, that's a bearish resolution of the squeeze. If volume remains low, even as price tries to break out, that's a failed move. And if the COT report starts showing a massive surge in speculative longs while commercials pile on shorts, that's a crowded trade warning. So I'm watching all 5 indicators continuously. They have to confirm each other. If one breaks down, I reassess the whole setup. Here's my final take. Technical analysis isn't fortune-telling, it's probability assessment. These 5 charts don't guarantee silver is about to explode higher, but they do show that the conditions are in place for a significant move. Momentum is building, volatility is compressed, positioning is reset, volume is waiting for a catalyst. And when you layer that on top of the fundamental tightness in physical supply and the strength in industrial demand, the setup tilts bullish. I'm not saying buy blindly. I'm saying watch the charts. Wait for confirmation. And when the breakout happens, be ready to act. If the breakout comes and you're sitting on the sidelines because you ignored the technical setup, you'll be chasing at higher prices. If you position ahead of confirmation and the setup fails, you'll be holding a losing trade. The disciplined approach is to wait for the trigger, confirm it with volume and indicator alignment, and then act with defined risk. That's how you trade setups like this without gambling. Tell me in the comments, which of these 5 charts do you find most useful? Are you a MACD person, an RC person, a volume person, or do you track COT data religiously? I want to see what the community gravitates toward because different traders use different tools. And often the best insights come from combining multiple perspectives. If this breakdown gave you a visual, data-driven framework to track the silver setup instead of just listening to hype, subscribe and comment FinTalk OG. And share this with someone who trades silver or gold because these indicators apply to both metals and this kind of multi-indicator convergence is rare. One last thing. This is technical analysis based on publicly available chart data and positioning reports. It's not a buy or sell signal. Markets are unpredictable. Technical setups fail all the time. I could be reading this completely wrong. Use this as one input. Manage your risk. Use stop losses. And only trade with capital you can afford to lose. All right, watch the charts, wait for confirmation, and I'll see you in the next one.